You check your portfolio every single day, sometimes twice. You panic sell when it drops 5%, and you panic buy when something's going to the moon on social media. You've read 12 investing books this year, and you're still more confused than when you started. Meanwhile, one of the most successful investors in modern history built a fortune doing almost none of that. He didn't check prices daily. He didn't chase trends. He didn't try to be clever. He just avoided the same 12 mistakes that nearly every other investor makes. Over and over, decade after decade, generation after generation, like clockwork. My name is Nick, and today we're walking through 12 investing mistakes commonly associated with the philosophy of legendary value investors. The patterns he's spent a lifetime warning people about, the habits that quietly destroy returns. And why almost nobody actually listens, even when the advice is sitting right in front of them. Mistake 1. Trying to time the market. You wait for the perfect moment to buy, and the perfect moment never comes, because it doesn't exist. Studies on market timing consistently show the same result. Investors who try to jump in and out underperform investors who simply stayed invested. Time in the market beats timing the market in nearly every decade of recorded financial history. The cost of sitting in cash waiting for the dip is usually higher than the dip itself. Mistake 2. Buying things you don't understand. If you can't explain, in 2 simple sentences, how a company actually makes its money, you're not really investing. You're gambling with extra paperwork. This is one of the most repeated principles in value investing. Stay inside what you can genuinely evaluate. It's not about avoiding new industries out of fear. It's about being honest with yourself when the only reason you're buying is because the price went up. Mistake 3. Following the crowd into hot trends. By the time something is trending on every platform, in every group chat, on every finance show, the early, asymmetric opportunity has usually already been captured by someone else. You're not getting in early. You're buying the exit of people who got in early and are now selling into your excitement. Crowds are often loudest right before the turn, not before the beginning. Mistake 4. Ignoring fees. A 1% annual management fee sounds small enough to ignore. But fees compound exactly the same way returns do, just working against you instead of for you. Over 30 years, the difference between a low-cost index fund and a 1% fee fund can quietly consume a third or more of your total ending balance. Same contributions, same market, dramatically different outcome, purely because of a number most people never bother to check. Mistake 5. Checking your portfolio constantly. Refreshing the app 5 times a day doesn't make you a better investor. It makes you a more anxious one. Every glance at a red number triggers a small emotional reaction, and emotional reactions compound into emotional decisions. The investors who check their accounts quarterly, rather than hourly, tend to make far fewer panicked, regrettable moves. Not because they care less, but because they've removed the constant temptation to act. Mistake 6. Selling everything during a downturn. Markets correct. They always have, and they always will. A correction on paper is not a loss. It only becomes a real, permanent loss the moment you sell. The investors who lock in actual damage are almost always the ones who sold in fear near the bottom, only to watch the recovery happen without them. Volatility is the toll you pay for long-term growth. Trying to avoid the toll entirely usually means missing the destination too. Mistake 7. Investing without any actual long-term plan. If you don't know specifically what you're investing for, retirement at a certain age, a number, a date, you have nothing to anchor to. And things will get uncomfortable. Every single investor eventually faces a stretch where the strategy feels wrong. Without a plan written down somewhere, that discomfort turns into abandonment at exactly the wrong moment. Mistake 8. Overconfidence in your own stock-picking ability. Professional fund managers, with research teams, data terminals, and decades of experience routinely fail to beat a simple, low-cost index fund. If trained professionals with every advantage struggle to consistently outperform, the odds aren't meaningfully better for someone making decisions on their phone during lunch. Mistake 9. Investing far outside your circle of competence. Buying into a complex industry purely on hype, without any real way to judge whether the business is healthy, removes your ability to make an informed decision. You end up relying entirely on price action and other people's opinions, which means you're not actually evaluating an investment. Mistake 10. Confusing a falling price with a bad investment, or a rising price with automatically being a good one. Price is simply what you pay in this moment. Value is what the underlying business is actually worth over time. These two things are related, but they are not interchangeable, and conflating them is one of the most expensive habits in all of investing. A great company can be a terrible buy at the wrong price. A struggling stock can be a wonderful buy at the right one. Mistake 11. Not reinvesting your dividends. Pulling small cash payouts out as spending money instead of automatically buying more shares quietly switches off one of the most powerful compounding engines. Reinvested dividends buy more shares, which generate more future dividends, which buy even more shares. Interrupting that cycle for short-term cash doesn't just slow your growth. Over decades, it can cut your total ending wealth dramatically. Mistake 12. Waiting for the perfect moment to start investing at all. Waiting for more savings, a better job, a clearer market, a less scary headline. Every year spent waiting is a year of compounding that simply cannot be recovered later, no matter how much you eventually invest. The cost of waiting almost always exceeds the cost of starting imperfectly, today, with whatever amount you actually have. Here's what ties all 12 of these together. None of them are about intelligence. None of them require an advanced finance degree to avoid. They're behavioral mistakes, patience problems, ego problems, fear problems, all dressed up to look like financial decisions. The investors who build real long-term wealth usually aren't smarter than everyone else around them. They're simply more boring, more patient, and far more willing to do nothing when doing nothing happens to be the correct move. You don't need 12 new strategies, 12 new tools, or 12 new apps. You need to stop making these 12 mistakes and let time, consistency, and compounding quietly do the rest of the work for you. Closing transition. Host's final reflective moment. Host direct address, warm wrap-up. Recap visual, all 12 mistakes in a grid. Host reviewing the grid. The patient's visual metaphor extended. The compounding engine, final triumphant state. Host's final encouraging gesture. Subscribe prompt setup, subtle. The 12 mistakes is a checklist for next time. Host pointing at the checklist tool. The boring investor. Identity embraced. Final visual metaphor, the steady tree growing. Host beside the mature tree, calm satisfaction. The educational disclaimer, friendly reminder. Host nodding at the disclaimer. Final montage, all 12 resolved mistakes one more time. The simple math of patience, one final chart. Host's final calm presence beside the chart. Closing, host's final warm goodbye wave. End card, channel brand. Bonus, final fade, 12 checkmarks glowing softly.